The fraud was so simple, an intern could have spotted it. Nobody looked. In June 2002, an internal auditor at WorldCom, named Cynthia Cooper, walked into her CFO's office and told him she had found something. She had been working nights and weekends, in secret, after her boss had told her to stop what she was doing. What she had found was approximately $3.8 billion in expenses that had been improperly reclassified as capital expenditures, a straightforward accounting manipulation that had inflated WorldCom's reported profits for years. The total fraud, when investigators completed their work, reached $11 billion. It was the largest accounting fraud in American history. The company filed for bankruptcy within weeks. 17,000 people lost their jobs, and the man who had designed the fraud testified against the man who had ordered it. To understand WorldCom, you need to understand Bernie Ebbers, and understand that before the fraud, he was a genuinely compelling figure whose story tracked the classic American entrepreneurial narrative almost perfectly. Ebbers was born in Edmonton, Alberta in 1941 and grew up in modest circumstances. He played basketball at Mississippi College, stayed in Mississippi after graduation, and spent his early career as a basketball coach, a teacher, and eventually a motel owner. He was not a technology person. He was not a finance person. He was a salesman and an operator who understood people and understood deals. In 1983, Ebbers and several partners founded a small long-distance telephone reselling company called LDDS, Long Distance Discount Service, in Jackson, Mississippi. The timing was fortuitous. AT&T had just been broken up by a federal antitrust ruling, opening the long-distance telephone market to competition for the first time. LDDS bought long-distance capacity from the major carriers and resold it to businesses at discounted rates. It was not a glamorous business, but it was a growing one, and Ebbers turned out to be exceptionally good at identifying and acquiring companies to expand LDDS's reach. Through the late 1980s and 1990s, Ebbers executed acquisition after acquisition, dozens of them, transforming LDDS from a small Mississippi reseller into one of the largest telecommunications companies in the United States. In 1995, LDDS changed its name to WorldCom, reflecting the scale its ambitions had reached. In 1998, WorldCom completed the acquisition of MCI Communications for approximately $37 billion, the largest corporate merger in American history at that time, creating a company that handled more internet traffic than any other entity in the world and competed directly with AT&T for the position of America's dominant telecommunications carrier. Ebbers cultivated an image throughout this period that was deliberately at odds with the Wall Street executive archetype. He wore cowboy boots and checked shirts. He drove a pickup truck. He taught Sunday school at a Baptist church in Mississippi. He raised cattle. He was folksy, self-deprecating, and apparently indifferent to the trappings of executive wealth that defined his peers. This image, the ordinary man from Mississippi who had built something extraordinary, was a significant part of WorldCom's appeal to investors who were skeptical of overly polished Wall Street executives. And here is what that image concealed. Ebbers had borrowed enormous amounts of money, over $400 million, using WorldCom stock as collateral for personal loans. As WorldCom's stock price fell in the technology sector downturn of 2000 and 2001, the value of that collateral fell with it, and Ebbers faced margin calls that threatened to force him to sell his WorldCom shares, which would have driven the price down further and potentially triggered a collapse of confidence in the company. Ebbers needed the stock price to stay up. And to keep the stock price up, he needed WorldCom to keep reporting the earnings growth that investors expected. The problem was that WorldCom's actual earnings were not growing at the rate the market expected. And that gap between reality and expectation was the opening through which $11 billion of fraud was driven. The mechanism of the WorldCom fraud was, by the standards of the cases we have covered on this channel, almost startlingly simple. Most large-scale accounting frauds involve complex financial instruments, offshore entities, multiple layers of transactions, and sophisticated techniques that require expert knowledge to understand and to detect. The WorldCom fraud required none of these things. It required only the decision to move numbers from one column of an accounting ledger to another, and the authority to instruct the accounting staff to make that move without asking why. In telecommunications, companies incur two broad categories of costs: Operating expenses are costs that are consumed in the current period, things like salaries, rent, and the fees paid to other carriers for carrying WorldCom's traffic across their networks. These costs flow directly through the income statement and reduce reported profit in the period they are incurred. Capital expenditures are investments in long-lived assets, things like network infrastructure, equipment, and buildings that are capitalized on the balance sheet and then depreciated over time, with only a small portion reducing profits in any given period. The distinction matters enormously for reported earnings, because a cost treated as an operating expense reduces this quarter's profit by its full amount, while the same cost treated as a capital expenditure reduces profit by only a fraction in the current period. Scott Sullivan, WorldCom's CFO, instructed the company's accounting staff to reclassify billions of dollars of line costs, the fees WorldCom paid to other carriers for using their networks, which were clearly operating expenses, as capital expenditures. The reclassification was not supported by any legitimate accounting rationale. The line costs had no long-lived asset associated with them. They were fees for services consumed in the current period, and treating them as capital expenditures was simply wrong under any standard of generally accepted accounting principles. But the instruction came from the CFO and the accounting staff, working within a corporate culture where questioning senior management decisions was not encouraged, made the entries Sullivan told them to make. Remember the opening image of this video, a pencil moving a number from one column to another? That is literally what happened. Billions of dollars of costs moved from the operating expense column to the capital expenditure column, quarter after quarter, transforming reported losses into reported profits. The fraud required no offshore accounts, no shell companies, no forged bank confirmations. It required only authority and the willingness to misuse it. The external auditors, Arthur Andersen, the same firm that had signed off on Enron's accounts and that was already under criminal investigation for its Enron work when WorldCom collapsed, had not detected the reclassification. The SEC, which reviewed WorldCom's public filings, had not detected it. The analysts who covered WorldCom's stock and who depended on its reported earnings for their buy and sell recommendations had not detected it. The board of directors, which was supposed to exercise oversight over management's financial reporting, had not detected it. Everyone with the tools to find the fraud had looked at the numbers and seen nothing wrong, until Cynthia Cooper decided to look harder than anyone else had. Here is what most people never learn about this case. Cynthia Cooper's boss told her to stop the investigation. She kept going anyway, working nights, in secret, using her own team. What she found in those late-night sessions changed American corporate law. Stay with me. Cynthia Cooper was WorldCom's vice president of internal audit, a position that, in theory, gave her the authority and the access to examine any part of the company's financial operations. In practice, internal audit departments at large corporations are frequently marginalized by the very management they are supposed to oversee, and WorldCom was no exception. When Cooper and her team began examining unusual entries in WorldCom's capital expenditure accounts in the spring of 2002, they quickly encountered resistance from the finance department that Sullivan controlled. Sullivan told Cooper directly to stop the review and defer it to the following quarter. Cooper was not an impulsive person. She was methodical, careful, and deeply professional. She did not immediately confront Sullivan or go over his head. Instead, she and her team continued the investigation quietly, working evenings and weekends to access the financial data they needed without alerting the finance department to what they were finding. They cross-referenced WorldCom's capital expenditure entries against the underlying invoices and documentation that supported them, or, in many cases, failed to support them. What they found was that billions of dollars of entries in the capital expenditure accounts had no legitimate asset documentation behind them. The entries existed, the assets did not. By June 2002, Cooper had assembled enough evidence to be certain that something was seriously wrong. She did something that required considerable personal courage. She went to WorldCom's audit committee, bypassing Sullivan entirely. The audit committee, which had been receiving clean reports from WorldCom's management and from Arthur Andersen, was confronted with Cooper's findings and immediately understood their significance. They brought in outside counsel and outside forensic accountants. Within days, the scope of the fraud was becoming clear, Not the $3.8 billion that Cooper had initially identified, but a figure that would eventually grow to $11 billion as investigators worked through the full history of the reclassifications. Sullivan was suspended immediately when the audit committee confronted him. He did not deny what he had done. He provided investigators with a full account of the fraud, the instructions from Ebers to maintain the earnings numbers regardless of underlying performance, the specific mechanisms he had designed and implemented, and the history of how the reclassifications had grown from a relatively small initial adjustment into the largest accounting fraud in American history. His decision to cooperate, to tell investigators everything about the fraud and about Ebers' role in directing it, was the most consequential single act in the entire case. It transformed a fraud that might have been difficult to prove into a prosecution with a cooperating architect who knew every detail of every decision. WorldCom filed for Chapter 11 bankruptcy protection on July 21, 2002, less than 6 weeks after Cooper presented her findings to the audit committee. It was the largest bankruptcy filing in American history, surpassing Enron's filing from just 8 months earlier. The company's 17,000 employees, people who had built careers at a company that had seemed, from the outside, to be one of the great American business success stories, faced immediate uncertainty about their jobs and their financial security. The stock, which had once traded above $60 per share, was essentially worthless. The criminal proceedings that followed WorldCom's bankruptcy produced outcomes that reflected both the strength of the government's case and the different choices that the two central defendants made in response to it. Scott Sullivan, who had designed and implemented the fraud, pleaded guilty to securities fraud, conspiracy, and filing false statements with the SEC. He agreed to cooperate fully with prosecutors in the case against Ebers, providing testimony, documents, and whatever else the government needed to build its case against the man who had ordered the fraud. In exchange for his cooperation, Sullivan received a sentence of 5 years in federal prison, a remarkable reduction from the potential sentence of decades that his crimes would otherwise have carried. Bernie Ebers chose a different path. He maintained his innocence, hired aggressive legal counsel, and went to trial. His defense rested primarily on a claim that he had not understood the accounting decisions Sullivan was making, that he was a deal maker and an operator, not a financial expert, and that he had trusted his CFO to handle the numbers without personally directing the specific manipulations Sullivan described. The defense pointed to Sullivan's cooperation agreement as evidence that Sullivan had every incentive to shift as much blame as possible onto Ebers to reduce his own sentence. It was a coherent defense. The jury did not accept it. Ebers was convicted in March 2005 on all 9 counts he faced, including conspiracy and securities fraud, and sentenced to 25 years in federal prison. At the time of sentencing, he was 63 years old. A 25-year sentence was, given his age, effectively a life sentence. His legal team pursued appeals for years without success. In December 2019, Ebers was released on compassionate grounds after serving approximately 13 years of his sentence, his health having deteriorated significantly. He died in February 2020 at the age of 78. Cynthia Cooper was named one of Time magazine's Persons of the Year in 2002, alongside Sharon Watkins of Enron and Colleen Rowley of the FBI. 3 women who had each, in their different contexts, found something important that the people around them had missed or chosen to ignore, and had found the courage to say so. Cooper later wrote a book about her experience and became a prominent voice on corporate governance and ethical leadership. She had done what auditors are supposed to do. She had looked at the numbers, found them wrong, and told the people who needed to know. The reason her doing so was remarkable was that everyone else in a position to do the same thing had not. WorldCom itself was restructured during the bankruptcy proceedings and emerged as MCI, the legacy brand that had been acquired in 1998. Verizon Communications acquired MCI in 2006 for approximately $8.5 billion, a fraction of what WorldCom had been worth at its peak. The telecommunications infrastructure that Ebers had built through his acquisition survived. The company he had built to contain it did not. And the 17,000 employees who had worked for WorldCom on the day of the bankruptcy filing faced futures that bore no resemblance to the futures they had planned when they joined a company that had seemed, from the outside, from the earnings reports, from the confident assurances of its Sunday school CEO, to be exactly what it claimed to be. Before we finish, drop one word in the comments. Scott Sullivan designed the fraud and got 5 years. Bernie Ebbers ordered it and got 25. Does that feel like justice? Or does the person who actually built the lie deserve more time than the person who asked for it? One word, justice. Or wrong? I read every single one. WorldCom was the biggest bankruptcy in American history, until 3 months later, when a company that had been hiding its problems for years finally ran out of road. Subscribe.